Muy buenas noches tengan todos ustedes. Good evening, Eric, from Australia. Welcome to this webinar. We are very pleased having you tonight. Let me explain a little bit to our audience the purpose of this presentation. Permítame pasar al español. Con el profesor Lilford, con la Lilford Curtin, estamos trabajando estos dos webinars, enfocados en la industria del cobre. Ustedes saben perfectamente que Australia y Perú son dos países en los que el cobre es importante. Y la Curtin es uno de los commodities que se analiza. Puesto en GERENS también. Entonces hemos considerado que va a ser muy interesante poder compartir desde un punto de vista, digamos, académico, desde las dos instituciones, cómo se está analizando la industria del cobre. Hemos tomado como marco general de discusión las variables globales, regionales y locales que inciden sobre la competitividad del sector minero y enfocado en el caso del cobre. Hoy día tenemos la primera presentación, va a ser hecha por el profesor Lilford, y la siguiente semana, el próximo miércoles a esta misma hora, va a ser la segunda presentación, que va a ser hecha por dos profesores de GERENS, el profesor Rodrigo Priale y mi persona. En ambos casos el foco es el cobre, en ambos casos son las estrategias nacionales y a nivel de compañía en esta importante industria. Permítanme presentar al profesor Eric Lilford. Él es profesor asociado en Minerals and Energy Economics de la Curtin University, ¿no? Él es también director en varias empresas, experto en paneles, es miembro de comités, tiene una amplia experiencia académica y también una experiencia importante en consultoría y en asesoría. El profesor Lilford ha publicado abundantemente, tiene varios libros, varios journals, es una persona con gran experiencia también financiera, lo cual es muy, muy interesante. Un placer tenerlo esta noche con nosotros. También quiero agradecer a dos personas que nos han apoyado mucho en la organización de este seminario. Son Jorge López, de la Australian Trade and Investment Commission, Austrade, Lima, Perú, y a Carlos Botero, que es Regional Recruitment Manager de Curtin University, con base en Bogotá. Sin más, bienvenidos a este encuentro académico internacional organizado por estas dos entidades académicas. Y damos el pase al profesor Curtin. Eric, please, could you go ahead with your presentation?
Thank you very much, and thank you very much for the introduction and also for the opportunity to present to you. Without wasting time, we have a certain amount of time to get through a fair amount of material, although the material is not from the point of view of trying to be a pure academic. This is trying to give you an overview or a purview of where the world is. And we all know that coronavirus has had a significant impact on the globe around us, on how commodities are traded, number of mining operations have been shut down around the world, what it's done to supply-demand balances. So there are a number of events that have forced our hand. On top of that, prior to COVID-19, of course, we have, and we continue to have, things like climate change, and whether you classify global warming hand in hand with climate change or a skeptic as far as global warming is concerned, that's not the point of what I'm trying to suggest. I'm trying to suggest that mankind has to do things differently. And part of doing things differently in the resources sector is looking what is the state of play from a global point of view, from a national point of view, and then from a regional point of view. What are the variables that we have to look at when we look at foreign investment or developing companies or building a mine or a mining operation or building a mining company? And that is what my presentation is largely around, with the focus on copper. And as you know, I have got a significant amount of copper experience. In fact, one of the companies I'm working for right now outside of Curtin, we've got copper exploration assets in Botswana and in Namibia. So just as a case in point, that's more copper. Right, so looking specifically at some of these global, national, regional aspects, what is driving the world economy as far as the commodities markets are concerned at the moment? Well, I've just mentioned COVID-19. It has an absolute global impact. We know the numbers are way up. The number of deaths is increasing by the day. In fact, the proliferation rate is increasing. So the impact of the virus, it's caused shutdowns and lockdowns right across the world. Australia went into a significant shutdown period. A lot of businesses were lost. Typically your service industries that are lost. Peru has also gone into a lockdown where you're trying to save lives. So the whole premise behind this deadly outbreak is saving of lives. Unfortunately, when you save lives, there's a hand-in-hand component that the economy tends to get hit. And as you're aware, I'm an engineer and an economist, so I don't put a numeric value on life. I can't say that, oh, it'd be worth killing so many people if only we could get our economy back to a certain position. That's certainly not the way I work. Thankfully, I do have a heart. So all in all, what we want to do is save lives. And then we have to look at ways of how we build the economies up again. So there's been an absolute significant economic impact. It's caused a global recession. Anybody who suggests that they're going to miss the recession, not this time. During the global financial crisis, yes, certainly China managed to avoid any recessionary impact.
Excuse me.
Yes.
Excuse me, Mr. Lilford.
Yes.
Sorry. We're not seeing your presentation. Can you share your screen, please?
According to this, it's on. It's being shared.
Okay. Can you check, please, on Google Meet window?
Can you see it?
There it is.
I wonder what happened because I hadn't touched anything. All right. Anyway, I haven't really followed the slides up to now. This is still the first slide. So let's just keep going. So you'd really only needed to hear what I had to say. Now we're actually looking at some of the points here. So I've said economic impacts and recession. A number of countries avoided the recession during the GFC, but this COVID-19, we are not going to be avoiding recessions around the world. On top of that, we have global debt, and that's sitting at a new high, and has an implication in the natural resources sector, because if global debt from an economy's point of view is at an all-time high, you have to consider where do mining companies now borrow future capital in terms of debt capital from in order to invest in new mining projects. I'll get to that because you have equity markets and you have got your debt markets. So what I'm saying here is that because of global debt, your debt is constrained. So we're going to be facing a number of years of constrained debt going into new mineral deposits or new project developments in the mineral sector. We've also got a changed world order. What do I mean by changed world order? Business will never be conducted the same way again. No matter how you try and cut it, because of coronavirus, business will never be conducted the same. A number of you will have worked from home. You'll find that office spacing needs to be broadened because this virus is here to stay. We will not find an antidote. We might be able to, it's much like a flu, we might be able to curb a strain or a variant in one particular season, but because it's a mutating virus, we unfortunately going to be having this virus with us for the rest of our lives. We're just going to be able to, like a flu vaccine, come up with whatever strain is going to hit that particular season and get inoculated against that. So on top of this, so the changing world order also impacts international travel. It's being curbed. It's being slowed down. I was supposed to have done a number of international business trips this year, and all of them have been put on hold. In fact, I now do most of my work through webinars, through online communications, etc. So international travel has been curbed. And the virus, as I said, cannot be expunged. We can only mitigate against it. In other words, we can't get rid of it. We're going to live with it, and we're going to have to try and work around it and have vaccinations that allow for survival pretty much. And then, of course, on top of all of this, we can see recently we've had a lot of damage being caused through wild accusations and retaliation accusations. And by this I mean that everyone's pointing a finger at China because that's where the virus comes from. Yep, is that fair? I'm not going to go into the politics of it, but the bottom line is that on top of this now, America is throwing its weight behind, pointing fingers at China. Australia's being damaged as far as barley sales into China is concerned. There's been tariffs imposed. There's just a whole series of knock-on effects. So a lot is coming to the head as a consequence of COVID-19. Moving away from that component within our global environment, we had, even before COVID-19, we had trade wars. The United States and China entered into trade wars middle to late last year, long before COVID-19. And they reached some form of agreement very, very recently. I think I made mention in one of my slides that there has been some kind of agreement reached in certain of the commodities. And I'm talking specifically about iron and steel. There's been a lot of iron and steel and aluminium as well. That's been the primary drivers in the US and China trade war. What we see now, of course, is China's flexing its own muscle, and it's doing that with other trading partners. And I point out that one of those trading partners is Australia. We're very close to China as far as distance is concerned. So for China to start imposing tariffs or to have impositions on Australia is very, very significant as they're a major trading partner. What about the climate? I mentioned climate change. What about climate impacting production? So we've got a lot of extreme events, extreme weather events becoming more and more common. We've seen floods from storms. We've seen tornadoes. We've seen shifting climates. We've seen hotter areas become even hotter again, colder areas getting even colder. There's been a shift in climate. So climate is very much a real issue caused by carbon dioxide or certainly greenhouse gases. Let's just leave it as common as greenhouse gases. And what is that doing to the resources sector? It's changing the way we do business. We're trying to become cleaner, more efficient. We're even looking at our primary sources of energy to power mines and mining operations and mining plants and processing facilities. We're powering them with cleaner sources of power, whether we can use solar, as in solar photovoltaic or solar thermal, or wind power. We're trying to use additional systems. The problem with these additional systems for providing clean power is they cannot provide what's called baseload power. So we still have a problem as far as energy storage is concerned. Elon Musk would like to believe that his battery cells, battery walls, and his Tesla battery farms are the solution. They're not. They cannot support enough energy for extended periods of time. And we've seen that as a case in point in Australia again, just outside Adelaide, where $100 million was spent on batteries to power the peak demand within South Australia. And those batteries only have a life of approximately 17 and a half minutes at full draw. So $100 million for 17 minutes of power. It's not a lot. So these are the realities of the world we're in. And then, of course, I've made the point here that China's capitalizing while the world stems a human crisis and an economic bloodbath. And the question then is, who's going to come out strongest? And logically, not logically, but considering where China is, we've got to be very, very mindful that China could very well come out on top of this. Now, I'll go into a little more detail on that. Right, on to looking foreign investment, foreign direct investment. This particular table. I think someone needs to be on mute.
Estimados participantes, por favor, mantener el micrófono apagado durante la presentación.
Okay. I'm going to carry on. I don't know if I can talk louder than that.
Listo. It's ready. I just mute.
Okay, thank you. All right, as long as you can still hear me. All right, so foreign direct inflows. What this world map shows, foreign direct investment flows during the course of 2018. And you can have a look far left-hand side. Obviously, there's Peru. And when you look at this, you can see that there are huge sums of money that are flowing from one continent to another or one country to another. The United States taking in $275 billion of foreign income, China $136 billion. Peru's taken in 6.8 billion. And one might say, well, that's not a hell of a lot. But then let's look at it from an emerging market point of view and from a per capita, per number of people, population. So Peru has a population of almost 30 million people. So Peru's income, foreign direct income over 2018 of 6.8 billion works out at $226 per person. That's not bad. Okay, USA was $833 per person. So its 275 billion overall income was 833 per person. So that's almost 3-4 times what Peru generates as far as foreign income is concerned. We know that China is the second strongest economy in the world, and probably after this coronavirus, it will be the number one and the strongest economy in the world. China's income, foreign income of 136 billion, but it's got a 1.47 billion population. So its per capita income was only $101 per person. So Peru is stronger from a foreign income point of view than China. And then you have a look at Brazil, one of your neighbors, or close enough to being your neighbor. Their figure was 63 billion income, foreign income, which works out at $170 per person. So they're not too far away from where Peru is. What this is suggesting is that Peru, even though the number itself at 6.8 billion doesn't sound like it's big, it's actually it's pleasing. It's a good figure to have. Taking that further, so we take foreign income and what do we do with it? Well, foreign income is a source of capital for spending on your economy. Outside of that, governments borrow money from wherever, the International Monetary Fund or from the World Bank, or there's general borrowings around the world. So a good way to have a look at how strong your economy is having a look at your debt to your gross domestic product ratio. And I've circled Peru on the far right-hand side of this particular graphic to show in the green that in a very strong position. Now, bear in mind, this is pre-COVID. I have not assessed and researched how much Peru is spending as a consequence of COVID. Every government is. Australia is spending close to $200 billion. America is somewhere around 600 billion and even more. So Peru, I'm not too sure what its figure is, but prior to COVID, Peru was in a very, very strong position because its debt to GDP ratio was only sitting at somewhere around 25%. That says to me immediately that Peru has the capacity for greater gearing. All right, and by gearing, what are we talking about gearing? Gearing refers to debt. It refers to debt on balance sheet. So even a government runs its capital accounts, and if you put debt on its balance sheet, we refer to that as gearing. So Peru, prior to COVID 2019, had the capacity or has the capacity to gear further. That also means that Peru could go out into the capital markets worldwide, borrow money for capital investments. In other words, for the development of further infrastructure to support Peru's local economy. So a very good position to be in. When you then look at emerging markets, so this particular graphic now considers Peru. You can see at number 4, there's Peru. Looking at 4 different parameters: your public debt as a percent of your GDP, your foreign debt, then your cost of borrowing, and then your reserve cover, all right? And your reserve cover is really just your foreign exchange reserve relative to your foreign debt payments and your current account deficit. That's what your reserve cover is. Coming in at number 4 from the emerging markets point of view, again, this really signifies how strong Peru's economy was. Again, I'm going to iterate pre-COVID 2019 because I don't know what those impacts are going to be on Peru itself. But you're in a very enviable position. You look at some of your competing countries who are big in the commodities that you are big in, copper and gold specifically. I mean, the DRC, Democratic Republic of Congo, doesn't even fall onto this. That would be a solid line of reds. So they would be below ranking 66, below Venezuela. Zambia, sitting at 64, big copper producing country, not a very good and very strong emerging market as far as the economy is concerned, which then provides additional risk to investors. South Africa, small copper producer, sitting at 47, not very strong at all. So you can have a look at that graphic and get an idea of how well placed Peru is compared with other players. Moving then on to what are some of your restrictions. So that's more or less your global perspective. Now you start looking at local, local as in regional or country specific or state specific, a nation. Whenever investors or anybody's looking to move or move capital into your economy, there are a number of facets they look at, a number of aspects, and these are them. The first thing that any investor looks at is what are the legislations? What legislation is in place to protect my right to tenure? The right to tenure is my right to hold on to a particular property. So if I'm talking about minerals and I have a mineral right, what security of tenure do I have? Is there going to be a change in government and then my tenure, my concession gets taken away from me? These are some of the risks that are looked at by foreign investors. They'll have a look at that right to tenure and the associated activities, okay? They'll look at all the laws and governing policies. What about the environmental aspects? Every country will have its own EIA, Environmental Impact Assessment Agency, or environmental department that will consider things like your baseline studies for environmental considerations for mining, your flora being your vegetation, your fauna being your animals, EIA, which is Environmental Impact Assessment. You have the agency itself, so the EIAs. And of course, you have disasters and potential insurance for disasters, and we've seen a few of those in Brazil with tailings dams collapsing and killing people. So environmental aspects are legislated. Health and safety forms part of your legal framework. There's potential liability associated with health and safety incursions or infractions. That liability often rests with directors. So again, I've been a director of a number of companies where you take on personal liability. As a director, you take on personal liability. Employment, what are your employment conditions? You have to look after your employees. So conditions are looked at, your employment conditions are looked at before foreign investment takes place. Then, of course, we get to pure economics. What are your tax rates? And I've got another table in here that will show you the comparatives. So what are the tax rates? Are you being overtaxed or undertaxed? What are the royalty rates? Royalties, it's not a simple case of saying, is there a royalty or isn't there? There are four key different kinds of royalties. There's an ad valorem royalty, which comes off revenue irrespective of profit. There's a unit-based royalty, also comes off revenue irrespective of profit. Then you actually get a profit-based royalty, which is a far better royalty system for a country because it looks to the profitability of a mining operation before the royalty is imposed. Much better system. And then, of course, the last one is what we call a resource rent royalty, and that is also pseudo-based on profits, but it's profits above returns. So those are the four royalty types, and we'll have a quick look at some of those royalty implications. Then what about your trade? Trade, you've got tariffs, duties, restrictions, barriers, local sales. Are there any of those in place? Trade, the ability to trade with national and international jurisdictions is absolutely critical as far as investing is concerned. Then we have this whole idea of governments or otherwise a legislated local participation. That's an equity stake. Some countries, the governments take what's called a free carried interest or a participative interest, or otherwise they force through legislation for local communities or local companies to actually take a participation as well, and that's an equity stake in the business. That can only ever be done at an asset level. You do not do that at a corporate level, and a number of reasons, one of them being that you cannot afford for a government or a local partner to sell equity. Because think about it, if a government sells equity, they might put demands when there's a change in government, they put demands on you again to replace that equity. You'd have to go and issue new equity to the government in order to be compliant. So you never issue equity with these participations in your holding company. You offer it your local participating company. Then, of course, you've got communities, which often goes hand in hand with your social license to operate. What is a community involvement? Is there upliftment? Is there a literacy program in the event there's illiteracy taking place? Is there upskilling? Are there bursaries or scholarships or education schemes in place that assist communities? Are you assisting with schools and with hospitals? These are things that are not forced on you, but as a socially responsible company, you're going to look at doing a number of these things in emerging markets. Then, of course, legislation around in-country beneficiation. to sell unwrought product is inefficient, and some countries impose penalties in the event that you do not upgrade and sell a higher beneficiated product. So there's higher royalties for unbeneficiated, and the more you beneficiate or the more you fabricate, the lower your royalty, or the royalty rate. And then there's additional things like your expatriates, levies, education systems, funds, and literacy. Specific legislation on governments. Keep in mind, a government owns the natural resource. No private company can own the resource. You own the right to mine. You own a permit. So the government owns natural resource, and they provide mining permits. The governments are there to create investor attractiveness. So to create an attractive investor jurisdiction for the development of the resources so that they can generate taxes and royalties for the betterment of society at large. And ideally what they want is a fair amount of this money, this investment, coming in from international sources, because that's a flow of funds as far as foreign direct investment is concerned. Governments are also mandated to share the benefits. So all the taxes and royalties they get, they need to use that money wisely. They put that into infrastructure, healthcare systems, into welfare, and to keeping the country ticking over, paying national, international debt, etc. Governments also have to ensure that natural resources are developed in a safe, environmentally acceptable and socioeconomic manner. I think we've touched a bit on that already, so let's just move on to the next one. They have to ensure income is derived from the natural resource and that those incomes are not squandered. We've seen, and we talk about corruption, there are so many different corrupt governments around the world that unfortunately pilfer or they take away these benefits from the nation. And then, of course, the final point is that governments are obligated to retain geological information. And this is on the point that if someone has gone and spent $100 million in exploration, but they don't actually end up mining anything, that information needs to sit with the cadastry. It needs to sit with the government so that if somebody in the future, commodity prices change, and someone in the future comes in and says, well, I want to go and see if I can go and mine where that person previously explored and they didn't mine, at least you've got the information. You don't have to go and spend the $100 million again. Carried or free carried interests. These are some of the government policies that are looked at, and some of them are frowned upon. So the carried or free carried interest, if you've heard of what a free carry interest is, an FCI, free carried interest is where a government takes an equity stake in a project and it does not pay for it. So if you've got a $100 million company and the government free carry is 10%, the government gets effectively $10 million worth of value, but it doesn't pay for it. So the company still has to be attributed the $100 million cost if there's a cost associated with it, and the government gets a free ride. Then, of course, there's local participation. I mentioned that. Taxes and duties, I think we've gone through enough in these. Royalties. Expatriation, critical. Can you actually get your money out? So when you look at foreign investors, they're bringing in, let's say it's $100 million as well. They bring in $100 million into Peru. They want to know that they can get at least that $100 million plus a return on the capital investment out of the country in order to make that return, or in order to make that investment viable. So expatriation of capital means that I'm able to invest and then get my money out plus my return. Withholding taxes prevent some of that return getting out of the country. So that's a negative as far as investing is concerned. But a lot of countries have withholding taxes. And then overall, sovereign risk. Okay, sovereign just means government. So sovereign risk looks to stabilization agreements, changing regulations, security of tenure, whether governments actually can be held to account. I mentioned that I had some comparatives for you. So Peru is there 2/3 of the way down on this page. Some of the taxation rates, royalty rates, VAT, GST, import-export duties, withholding taxes, government participation, etc. These are included in this table. You'll see right at the end of this presentation, I make mention of a book that I have written with another professor from University of Western Australia, all around mining taxation. It's around the economics, because as I said, I'm not a tax specialist, I'm an economist. And in there, I've got a table very similar to this, but it covers probably more than 80 different countries. What I've done is I've just filtered down to some of your competing countries as far as commodities are concerned. So Peru's overall CIT is your corporate income tax. CIT rate 29.5%, and it does have a royalty range. it also has a withholding tax of 5%. You look at one of your major competitors as far as the copper market is concerned, Chile, just slightly above, it's got a much lower tax rate. Its royalty rate is also favorable at a 0 to 14% range, but look at its withholding tax rate, very, very high. So in other words, for every dividend you issue, 35% is going to be retained in the country in the form of a withholding tax. So that, when I do a valuation, would I invest in Chile or would I invest in Peru, that 35% makes a huge difference to my investment decision. Furthermore on copper, so let's have a look at what the prognosis is for copper going forward. 2019 has come and gone, we're in 2020, and you can see the expectation for copper specifically to grow at a rate of, I think it's about somewhere around 3% per annum for the next 7 or 8 years. So there's a forecast of what's expected for mine production and the overall growth. And even though the growth in the little red line shows it coming off, it's still positive. So don't think that just because the line is coming down after 2023, that we're not growing, we're not declining. It's still above 2.5%. It's just your rate of growth is expected to decline as more and more mines come into production and demand doesn't get to meet that additional expansion or new projects. So the outlook for copper is very positive, even after COVID-19, because copper is an industrial commodity. And as long as you have industrialization with this world's population, copper will be in demand. You also consider that for an electric vehicle, the amount of copper used in one electric vehicle is approximately 6 times the amount of copper used in a conventional combustion engine vehicle. So 6 times the copper, and we're trying to get cleaner and cleaner. We're going with electric vehicles, a lot more copper is required. So there's lots of room for copper growth as far as production is concerned. Let's look at the country specifically. Peru should be very pleased and very well placed. It is very well placed, but very pleased looking at where it sits on this particular chart. Peru's got a whole host of new projects coming online, and they will be coming online over the next 7 to 10 years. There's very little that Peru can do as far as expansions of existing mines are concerned. Whereas Chile's got a little bit of the opposite. They've got a lot of expansions coming online, and they've got fewer new projects coming online in Peru. Now the axis is number of projects. So the 0, 25, 50, 75, those are number of projects, not value of projects, not amount of production in tons. Those are number of projects. So Peru has got somewhere around 28 or 29 new projects that are lined up and approved in the copper sector. Right, the final piece that I want to delve into is looking at the sovereign risk and investment criteria. So is Peru actually an attractive investment destination for mining companies? Should mining companies, international mining companies, invest in Peru? Well, we mentioned the word sovereign risk. This is a sovereign risk ranking from Standard & Poor's, that's S&P, Moody's, Fitch, and then DBRS Morningstar. DBRS Morningstar, I typically ignore them. They're not as well known, and they don't cover the entire world. But again, looking here, Peru is about 3/4 of the way down. You can see it's a triple B plus from Standard & Poor's. It's a triple B plus from Fitch, and it's an A3 as far as Moody's is concerned. Now, the reason why you've got different colors here, green is all investment grade, as in strong investment grade. All the black, which is typically your B rankings, are not neutral. They're marginally positive, but have to be watched. Your red is just don't go there. So you can see the DRC sitting with a CCC plus. That's not investment grade. You can also see that Fitch says Zambia is not investment grade. I know for a fact that South Africa very, very recently lost one of its gradings as well. So South Africa is sitting, that Moody's, the BA1 has changed to a BB minus. So they are looking on the margin. Again, what this is showing is that Peru is in an okay position. It's not a preferred destination as far as sovereign risk is concerned, but it's not a basket case because of sovereign risk. So it's in a good position. Very, very quickly, because this gives an idea of what's the importance of sovereign risk. You know, so what? Who cares about sovereign risk? Well, whenever I invest in projects, or anybody invests in projects, they want a rate of return. That return is dictated by the yield in the government bond, all right? So Peru will have issued a number of government bonds, whatever their tenures are, 10 years, 20 years, 30-year bonds, and you are guaranteed a return. That is your yield. The yield is classified as your risk-free rate. So it's a pre-tax risk-free rate, and what the government is saying is that we guarantee we can generate this kind of a return for our country if you invest in a government bond. That then is a precursor for how we calculate our potential investment returns for, from an economics point of view, for investing in the sector, whichever sector that is, mining sector. Of course, there are other economic-based factors that impact your decision-making, things like your market volatilities, all right? There's a fancy word, we call them betas. Those are your market volatilities. You look at a specific investment and you determine how volatile. Now, one might say, I want high volatility because high volatility means you could make a high return. A high volatility also means you could make a high loss. So there's a risk. It's what kind of capital have you got to invest? If you've got excess capital and you prefer to take high risk, you want a high beta, you want high volatility. However, if you've got a bunch of shareholders who do not want you to gamble their money, then you want lower volatility. Those two factors, your betas and your yields, we use these in the calculation of our cost of capital. When we do a valuation for a mining company or a mining project, we use a discount rate. How do you calculate the discount rate? These are some of the factors that give you the numerics behind how we calculate discount rates. The final point, of course, is that debt is nearly always cheaper than equity. So again, come back to the word gearing. So gearing is important. You look at your debt to equity split. We always want as much debt as possible, but your debt providers, being your commercial banks, want you to put in as much equity as possible. They want you to put risk capital, that's your equity. So the combination of the two, we get a weighting, and the weighting is your weighted average cost of capital. So what the final point on this one is that a return on the investment in excess of this weighted cost, that creates an attractive economic investment opportunity. And as I said, it's the kind of thing that I look at when I go into, as I said, Botswana and Namibia, where I'm looking at now. I have a look at their government yield rates. I also look at what their volatilities are for the copper sector, and specifically copper commodities or copper stocks within those two countries, and see how volatile they are. And then I determine what kind of a return above a discount rate or above a cost of capital do I want in order for me to part with my hard-earned capital and invest in a mining venture in one of those countries. And I'll do exactly the same for Peru. Right, the last few slides are just giving you a heads up on where Peru is specifically relative to the rest of the world, and largely from a copper standpoint is concerned. One of the groups, Fitch, so I said Standard & Poor's and Fitch. So Fitch actually has a division called Fitch Solutions, and outside of sovereign risk, they look at various facets as far as research is concerned, and I picked up on their copper research. And what Fitch said, and this is just last month, they said that your global copper production is going to increase by about 3% a year up to 2028, reaching somewhere around 27.8 million tons a year by 2028. And you saw that in that previous graph, so that was also their graph. What they've also said is that tariff dispute between the US and China, it depressed or suppressed prices, copper prices in 2019. So copper has been trading between $2.50 and $2.70 a pound. What's important about that is the next piece that I've put in highlights here. That price range, that's below the level the industry requires to build new mines. Remember, I spoke about returns. The surest way of getting a decent return is getting a decent price on your commodity. So when your commodity prices are trading at somewhere around 250 cents a pound or $2.50 a pound, can you, after taking off your operating costs and capital expenditure, generate enough of a return that you're going to invest? That's the question that has to be asked. And the point this is saying is that at $2.50, $2.70, it's very few new mines are going to be coming into production. Right. However, from March 2020, copper had become bullish again, and we've seen that there has been an improvement in copper prices since March. Global copper production is expected to exceed 4% a year just for those 3 years, 21, 22, 23, and your key producers, Peru and the DRC, are going to be major contributors to that growth. As I said, there are a number of new projects, and both Peru is right up there with new projects, but so is the Democratic Republic of Congo with its much higher sovereign risk. Furthermore, Fitch also said that Peru's mine output growth is going to outpace that of Chile. Remember I showed you the graph that showed new mines or new production versus expansions. So Peru's output will grow, new output will grow greater than that of Chile. And as a consequence of that growth and the foreign investment policies as well as your sovereign risk, and despite mining protests, there have been anti-mining protests in Peru, your international companies, your multinationals will continue to invest in Peru. And that's because of these things like your stable regulatory environment, ample reserves, etc. There's an example, Southern Copper. They've got a strong project pipeline, spending $1.4 billion on the Tia Maria project and the $2.5 billion Miquile project and another $2.8 billion on the Los Chanza project. What I do want to point out, and I will come back to this point in my final slide, Chinese investment. And I know that there's a fair number of Peruvian operations that are invested in by Chinese companies, Minmetals, China Minmetals, and others. So Chinese investment will continue to play an important role in your copper sector. The miners are seeking to diversify the supply to compensate for Chinese domestic consumption being greater than their supply. So that's what China's got a strategy. China's looking to secure commodities, not just copper, but we're talking about copper, to secure additional copper supply because in and of itself, China can't produce enough of its own. So it's going around the world, laying its hands on whatever equity it can get in the copper industry. And they've got significant investment in the DRC and in Zambia and elsewhere. And India, there are a number of Indian companies that are trying to do the same. India have got quite a big presence in Zambia because of the copper. But my point is on Chinese, and I'll make that clearer in a second and why. In for Peru's Ministry of Energy and Mines, there was a statement by Fitch that they said Peru will see a total of $10.2 billion invested in 5 mining projects over the next 10 years just by Chinese firms. $10.2 billion. Remember what we said, that foreign investment in Peru was $6.8 billion in one of the years, all right, in 2018. So over a 10-year period, so one might say that if you divide this by 10, you're getting $1 billion a year. So $1 billion a year is going to come out of China alone. That's quite significant. That's nearly 20% of Peru's annual investment from foreigners coming from China. Right, Chinalco, the Toromocho mine, that began commercial production in 2015, and it's going to invest about $1.3 billion expanding the project over the next few years. MMG, which is China Minmetals, they acquired the Las Bambas mine from Glencore in 2014, and with their Galena project, they're looking at spending another $3.5 billion in developing that project over the next number of years. So huge investment coming in there. It is part of the $10 billion that we mentioned above. Then as a final point here, Fitch Solutions, they revised down its 2020 copper mine production growth forecast for Peru specifically. It was previously at 5%, it's down to 1%, but it's still a growth. Largely, this is the uncertain timeline of the Toromocho expansion project and also the Mina Justa project. But bear in mind, this is a downgrade for one particular period in time. This will be picked up again on the other side when the investments are being made. So instead of a 5% this year, you're down to 1%. And next year, instead of 4%, you might be at 6%. So what will happen is it'll be deferred. It's not a case of it's been avoided or it's not going to be spent at all. The investment will still take place. It's just a deferred expenditure. Fitch Solutions also saw that your downside risk will come from your declining grades across Peru. Most countries have this. Unfavorable climate, specifically climate. And again, I mentioned climate change. Protests, so this is labor, they hamper supply chain operations and union strikes. Again, a lot of countries have these kinds of issues anyway. It's how it's managed. It's not how to avoid it. You can't avoid these things. But how are they managed? How do you appease your stakeholders, largely your employees and your representatives? Common across Peru's mining projects, the aging mining projects, the declining ore grades can be mitigated by technology improvements, and that then improves efficiencies. So we have technological changes that are taking place all the time. Those can compensate for some of your declining ore grades. And then I mentioned disruptions. That's largely Peru and Mexico. It could see, just for a very short term, your Q2, which is your second quarter, which is the quarter we're in right now. You could see mine supply fall because of these disruptions, and what the implications are. Part of that is your lower spot treatment charges highlighting shortages in concentrates. Right? I won't go into the details of TCs and RCs. I think that'll be for another discussion that goes deeper into mineral economics. But there are lower spot treatment charges, which treatment charges are associated with concentrates. RCs, your refining charges, are associated with finished metal, or near finished metal, something like a metal, a copper matte, or a blister copper. Those will be your RCs. So TCs are the issue here. For Chile, I'm not going to read this final piece here. The bottom line is that there is modest production growth. Spence, Candelaria, Antofagasta, Centolina, and the Quebrada Blanca. But we saw that as far as new mines are concerned, Peru is outpacing Chile anyway. Right, on my final slide, what I've got, I just wanted to spend another minute or two, if you bear with me, on COVID-19 specifically, because the outfall, as I've said, is other than lockdowns, and yeah, those are some of the impacts, but there's a bit more to it. So the global markets have been paralyzed. They've come to a grinding halt. The economy has been badly affected, and as I said, a global recession. Every country will have a recession. What's happened to the commodities market specifically? Well, as COVID hit, companies were still producing, operations were still producing commodities, but there were no buyers. So in other words, your demand disappeared, but supply continued. So all your markets were in surplus. But since then, a number of mines have been shut down. You recall that South Africa shut down all of its operations. And that is in that little graph right at the bottom, the very, very far right-hand side, you can see, if you can read that, it says platinum. And it shows you there of the disrupted capacities of platinum and palladium, and they're actually PGMs. And the reason, or that one's platinum specifically, and palladium is right next to it, and you can see 37% for platinum and 19% for palladium. Well, South Africa is one of the world's largest, it is the world's largest producer of platinum, and it's the second largest producer of palladium behind Russia. And South Africa shut down all its mines. So there was a massive shortage of supply. Or a massive supply disruption that took place in the PGM, platinum group metal sector. So commodity markets were in surplus, but they're rebalancing because mines were shut down and people aren't working because of social distancing, etc. So this comes down to being a demand side issue. Copper, which obviously is an industrial commodity, is going to recover, but it's going to recover over a period of time, probably over a 2-year period. Gold, yeah, this presentation is more about copper, but you can't ignore gold because that is your safe haven. It's a store of wealth. So gold is a perceived safe haven. So physical and associated investment instruments are in demand. I talk about the associated investment instruments. These are things like puts and calls and various traded instruments that are out there where you don't actually take ownership of physical metal. So unlike the oil sector, which had these instruments which come with the ultimate physical delivery of oil, which is why we saw the WTI drop to a negative for the first time ever. Gold, this can't happen to that kind of aspect. Your international travel impacts. I mentioned that people are not flying. There's no international travel taking place. So there's a whole host of that is being curbed, and it's not going to be back to any normality anytime soon. International borders are not going to open easily. Operations are likely to mechanize more, so trying to avoid the human factor. Now the human factor is multifaceted. One is obviously what I said earlier on disruptions and strikes, and that's one of the reasons why mining companies would love to move away from labor-intensive workforces. The other one is from a health point of view. So because of COVID-19, there is a stronger move towards mechanization. Mines will have to do health screening, they'll have to change rosters, but they are likely to go more to mechanizing. Mechanizing means that there's greater opportunity for further capital and capital investments in that mining sector in Peru and elsewhere. I also stated that as far as equity and debt is concerned, notably on debt, available capital for new projects has been reduced. And part of it is risk-driven, and some of it is truly capital adequacy. You'd show me one single financial institution listed bank that share price hasn't been absolutely hammered over the past 3 months. They all have. So when you say, well, the share price is not how much capital it's got to lend, the issue is capital adequacy. Every country in the world has regulations regarding capital adequacy of your financial institutions, which means that as your equity value dissipates, so you have to store greater and greater on-balance sheet funding, which means that that funding can't go out to borrowers. So it does have an implication. The share price, unfortunately, does have an implication on how much money can be lent out by banks. The equity, as I say, well, if people are losing money in the equity markets, it just means that any additional equity for new investments is somewhat diminished. My final point here is beware the rise of the dragon. Now, I'm not a politician, but I do want to put out there that China's taking advantage of the situation the world is in currently. They are taking equity stakes left, right, and center. They are spreading their exposure. They are taking ownership in many projects worldwide. They are a number of countries, and these are not my words, they play bullying tactics. And it's one of the things that keeps China strong. They do go into environments that are struggling or that are looking for capital or cannot source equity from elsewhere in the world, and they'll take on additional risk, but there's always a price to pay. Often that price is in terms of offtake. In the old days, China used to provide funding solely for offtake. In the past 10 years, you will have noticed that China takes more and more of an equity stake. They actually take ownership stakes in companies, and it's something that has to be watched very, very carefully. I'm not going to say more on that because, as I say, I start opening up a political can of worms, and I'm not a politician, and I have no intention of doing that. I'm just watching what the markets are doing from an economics point of view and who the investors are out there, and it worries me that China is the largest investor during a period when the world is suffering. That final graph there, you can see where copper was hit to the tune of 18%. And we have a certain amount that is still disrupted, around 10%, and the reactivation part, 8%, is what is certainly being put back in place. That's the end of my my discussion, so certainly happy to take questions. I mentioned to you that Pietro and I wrote a book, and it's only going to be published. I actually got an email from them yesterday to say the book will be published on the 7th September. It sounds very dour. It sounds very boring. It says, it's mining, are all about mining taxation, reconciling the interests of government and industry, and it goes way beyond just tax. So it's an interesting component within the resources sector outside of just pure government taxation. As I said, it goes into quite a bit of detail, so watch out for that. All right, on that, I'm going to, I see that there's a whole host of questions and comments, so it might be easier, Alex, or if one of you highlights the questions rather than me jumping around trying to find where the questions are. Is that the best way to do it?
That's right, Eric. Thank you very much for your very interesting presentation. Extremely interesting, your view from the other side of the Pacific. How do you see Peru? Very, very interesting that you see us strong in foreign investment, strong in the debt equity ratio, number 4 in cost of borrowing, reserve cover in this The Economist book. So you see a lot of interesting indicators. The only one that you don't like is the sovereign risk. You see that Peru is in the middle. Would you reconcile that fact with the huge investment that Peru has been receiving in spite of the foreign risk?
An interesting question, because what transpires as far as sovereign risk is concerned is that your companies will look at the potential return they can generate. And the reason why investors are still keen to invest in Peru is not because of the sovereign risk. Obviously, sovereign risk is the warning. It's the warning because you sort of on the margin, there is risk. But what do mining companies do? They look at a higher return for higher risk. So in the event that you have got a higher risk rating or your return, your yield in a government bond, which is tantamount to your risk factor, is higher, an investing company, a mining company will say, well, then I want a return higher than that again. So instead of going for something like maybe an internal rate of return of only 12 or 15%, they may say, well, if I'm going to invest in Peru, I want an IRR of 20%. So they will make their decision based upon the economic parameters associated with sovereign risk. So in and of itself, sovereign risk can be a problem, but what it does mean is that your investors are looking for a higher return than if they invested in, say, Australia or America.
There is a question connected with this.
Yes.
And the question is, do you think that geological potential can counterbalance the country sovereign risk?
They actually, there's an aspect that they are unrelated, but there is some certainly a correlation. So you ask the question, the exploration attractiveness or the mineralization of Peru and the undiscovered portions or parts or opportunities certainly outweigh the potential risk of what sovereignty brings. Now bear in mind what we refer to in terms of sovereignty. A sovereign nation only factors in a certain amount of sovereign risk for the tenure of the government in power, because if government changes, and I'm saying this, say, from an Australian point of view, where we have got Labor versus Liberal, and after 3 years, Labor comes in, and the next 3 years, Liberal comes in, and they keep changing the rules. That impacts sovereign risk. So I'm not saying necessarily it's a good thing or a bad thing, but it does change your sovereign risk. So again, what your mining companies are doing, they're looking at sovereign risk in total. They're looking at the exploration potential of Peru in total. Then they're looking at the aspects of things like security of tenure associated with sovereign risk. So if a country, if a company can enter into a state agreement, which is a binding agreement between the government and that particular company, that even with the change in government, they can't change the rules associated with a specific investment or a specific opportunity, that goes a long way to mitigating what that potential sovereign risk might be. But as I say, there's almost a disconnect between the two. And the connecting point is what kind of return you want. The higher the sovereign risk, the higher the return. So you talk about the mineral potential of Peru. Yes, it is significant. And mining companies know that. And they will continue to explore and look for and develop mining projects in Peru as long as they can generate an adequate return for their own shareholders and stakeholders.
Thank you. There is another question, Eric.
Yes.
What do you think about the role of copper scrap trading? Can it lead to a future downside of copper price?
Copper trading?
Scrap trading, scrap. Copper scrap.
Copper scrap. Yes, sorry. Yes. So your secondary market. Absolutely. Most definitely. But again, keep in mind, let's consider the factors. Where is copper used? Copper is an industrial commodity. It's used in buildings. It's used in electrical reticulation. It's used in power supply. It's used in electric vehicles. It's used, so anything to do and everything to do with electricity. It's used in cathodes. It's an industrial, it has an industrial use. Copper has been used for decades, if not hundreds of years. And throughout this time, there is copper scrap. There's a lot of copper scrap that comes into the market. In fact, around about 22, 23% of all new copper comes from copper scrap. What has it done to markets? It has not negatively impacted markets. And why is that the case? The reason is quite simply because we have got a continuously growing global population. The world's population is currently sitting at it's about 7.8, somewhere around there, 7.8 billion people. By the time we get to 2050, the figure is expected to be just over 10.5 billion. That's continued population growth. And the more and more people you have on the planet, the more and more copper is needed because it's an industrial commodity. If you go high-rise buildings for accommodation, there's a lot of copper in there. If you have more and more public transport, there's a lot of copper in there. We try and change copper into clean electric vehicles. You consider that the electric vehicle market using 6 times more copper than a combustion engine, that over time what you're going to get is your combustion engines going into scrap, and you'll take all the copper out, but you'll need 6 combustion engine cars scrap to give you the same amount of copper that you need for one electric vehicle. So copper scrap will always, and in fact every commodity has a scrap component to it. And I do not believe that that's going to have an impact on desired demand for new production. So no, it's not going to have a significant impact.
Thank you. There is another question regarding this comparison between Chile and Peru. You mentioned that you see that Peru might surpass Chile in progress. Chile also has a large portfolio of new projects. And now Peru is approximately 1/2 of Chile's production. Could you support this assertion that Peru might produce more copper than Chile, which is a very interesting proposition?
Oh, absolutely, it is. It is. In the first instance, remember what I also said is I started off by saying the number of projects, number of new projects. So the graph is that is what we were looking at, is to say that we have, in fact, if I got it up there, it was in there somewhere. Anyway, don't need the graph. That the number of new projects coming from Peru is significantly higher, not necessarily on a volumetric basis. So we're not talking about more and more earth being moved. It's volumetric, and to the extent that there's greater production of actual physical copper, it's because your grades are better. So even though I make the statement that Peru's grades are declining like every other country in the world, that's why Chile at some point used to have grades well in excess of 1%, but it currently mines, I think Chuquicamata sits at about 0.35 or 0.37% copper, but it's an earth-moving exercise. So they move billions of tons or hundreds of millions of tons of earth to get out 1 ton of copper, whereas Peru's grades are higher. So you move less earth to get the same, if not more, amount of copper. So the difference is largely associated with grades. Peru's grades tend to be greater, so you need fewer projects in order to produce more. So it's one of the driving factors behind why Peru's outlook is in a better place than, say, Chile. Chile is looking at lower and lower grade new production and expansions.
Very interesting. Another question regarding the demand for government bonds, Peruvian government bonds. Very recently, Peru has issued bonds, and it had a huge demand. Actually, the demand surpassed largely the supply.
Yes.
How would you explain this, considering this risk rating that you show
again? Yep. So when a government issues a bond, when it's issuing, effectively what a bond is government debt. What they're trying to do is package government debt. So they bring in income, they issue an instrument, and they guarantee a return. That allows the government to take that capital, invest in infrastructure or something that's going to generate taxes for the fiscus. They use that fiscal income then to pay out the yield, which is the return on that government bond. So just because Peru has got a risk rating higher than any first world country, and it's sort of in the middle of where emerging markets are concerned. In fact, it's looking one of the better ones as far as emerging markets are concerned. There's an expectation that its risk for an emerging market is a lower risk than other emerging markets. But the risk is still high. In other words, your yield is still high, your returns are still high. The dividend, in inverted commas, from the government, which is the yield, is still high. So I'll give you a direct comparison. If I, as an investor, I sit with $100,000, do I put it into an Australian government bond where I know my yield is somewhere around 1.2%? Or do I put it into a Peruvian government bond where I know my yield is somewhere around 6.5%? And immediately I'm thinking, well, 6.5% return is much higher than 1.5 or 1.2% return. Yes, there's greater risk, but that risk is how comfortable I feel with the Peruvian government. Now, I don't think the Peruvian government is going to steal my money, and I don't think they're going to collapse the economy. So I'm prepared to take that additional risk in order to get a much higher return. So when governments issue bonds, often they are oversubscribed because a lot of your locals who take up those bonds and say, well, this is my government. I trust them. I think they're doing well. And I'm therefore going to buy a guaranteed return. It's less risky than going into the equity markets.
I see. Another question regarding high arsenic content. Could you share with us your thoughts regarding technologies with copper and deposit with high arsenic content?
Yeah, so now I've worked on specific projects in South Africa and in Zambia, which are arsenopyrites. And the arsenopyrites that obviously when you separate out, you end up with arsenic, which is unwanted. Now, there are a couple of ways of dealing with it. Typically, your arsenopyrites, you'll use some sort of a refractory method of extraction. And using refractories means that you're allowed to, or you can actually separate out the arsenic. Unfortunately, treating or dealing with arsenic, neutralizing it, I'm not a chemical engineer, but I do know that the mines that I worked on, we literally put the arsenic into 44-gallon drums and sealed them with the hope that in some future life we might be able to use it for something. Arsenic is used in certain processing regimes for different commodities, so we could sell some of our arsenic, but we were producing more than we could actually sell. The other problem you've got with arsenic, as you're well aware of, will be that if some of your arsenic gets through your process and ends up either in your mat or your blister or certainly in your concentrate, you're going to pay away significant penalties for the arsenic content. So when you talk about TCs and RCs, your treatment charges, your refining charges, TCs on copper concentrate, you've got arsenic, you're going to be penalized significantly because the smelter and refinery that have to then deal with that arsenic have to pay for the treatment of the arsenic and neutralization of that arsenic. And neutralizing arsenic is an extremely expensive process. So unfortunately, there's no simple solution. You can't get rid of arsenic. The moment you start concentrating your copper and taking it up from 1% in ore up to 30% in concentrate, you're also concentrating your arsenic because that comes with the copper. So it's a problem that the world has, and sadly, the only solution is to try and avoid arsenopyrite deposits. Maybe there are some other technicians, engineers out there who have managed to do some separation of arsenic at a decent cost, and they can get away with it. But I know from my personal experience point of view, arsenic is one of those terrible things you've got to deal with. It costs you to work with it or to extract it, and it costs you to store it because it's a toxin.
Thank you. Peru has a number of arsenic content copper projects. That's why this question is very important. Eric, we could go on and on, but the time is almost finishing. We have one more question. You presented a very interesting chart showing that Australia and Canada dominate the new copper projects. Peru is number 4, Chile is number 3. However, you also mentioned that with copper prices around 2.5, $2.7 per pound, some of those projects would not fly. What about the quality of this project portfolio that you have presented us? Can you share with us your thinking about the quality of those projects?
Yes, so certainly Canada and Australia, a number of the projects are relatively low grade. In other words, at $2.50 and $2.75 range, they're not going to make money. So there is a risk. But what is happening in those two countries, in Canada and in Australia, is there's an outlook, and that is looking further out beyond 1 or 2 years. These projects are being developed. They are going to bring new production online over the next 5 to 7 years. And the expectation is that by then, your copper demand will have picked up and will be in a far better place, and your prices will have moved back above the 300 cents a pound, or somewhere around $6,200 a ton. So the expectation that these projects are being developed in the various countries with an expectation that your markets are going to improve. Now, these market improvements are on the basis of industrial growth around the world. So even though the world is facing down 2 barrels of a loaded recession gun, recessions don't last forever. So the expectation again is that reinvestment or investment in preparation for the future demand from an industrial point of view will pick up, and therefore get your project ready now. There's an age-old adage in the economics fraternity, which again was some of my experiences in days gone by. The best time to build a new mine is when your commodity prices are depressed. So this is exactly what's happening now. I think these projects were already put online and were starting to be developed before COVID-19. COVID-19 hit, prices have gone down, and the thinking is still now is the best time to be investing in these projects, assuming you can get the capital, the equity and debt. Get these projects up, because in the next 3 or 4 years, when you're actually ready to produce, there'll be a market for it and your prices will be in a far better position.
I see. Thank you very much. There are a number of questions. Additionally, unfortunately, we ran out of time. We want to thank you very much, Eric. And also, we would like to invite you and our viewers to next week's second part of this webinar, on which we are going to discuss about these same topics from this side of the Pacific. Global, regional, and local variables of the competitiveness of the copper industry. So thank you very much, and we hope to. I'm sure that our audience is extremely happy with this presentation. I am going to let Alex Guamán to give some final introduction. Quiero agradecer a todos los participantes. Ha sido una discusión muy rica la que hemos tenido con el profesor Eric Lilford, y los invitamos la próxima semana a la segunda parte de este conversatorio, en el cual vamos a tomar estos mismos temas, pero de este lado del Pacífico, digamos, como vemos desde Perú la industria del cobre. Adelante, Alex.
Thank you very much, Mr. Lilford, for this excellent presentation. Se les pide a los participantes, por favor, llenar la encuesta, una breve encuesta que se acaba de compartir mediante la ventana de chat, para seguir mejorando estos seminarios y poder darles una mejor calidad y un mejor servicio. Muchísimas gracias a todos nuevamente. Por favor, les acabo de compartir la breve encuesta por la ventana de chat. Muchas gracias.